There is a crisis going on in America currently, a crisis that affects millions of people, and one that real estate agents might play a role in solving or mediating, but you're not going to hear it from your normal real estate agent at all. And this crisis that I'm talking about has nothing to do with the Middle East or debt spiral or anything. It has to do with retirement and how people don't have anything saved for retirement. And this is a big, big problem as more and more boomers reach retirement age. Gen X is up next for retirement, and the average retirement savings is like $100,000. And that is a pretty good. And most people don't have two nickels to rub together in retirement other than the equity in their home. And so there are tons of people sitting on a lot of equity, and it's really become the default retirement savings plan for Americans because they don't have anything else saved. And we can talk about the reasons for that. They're complicated. There's a myriad of reasons. But the fact is, people are relying for the sale of their home a lot of times to provide for them in retirement. And so where does that leave us as real estate agents serving a population of people that are in this position where all their equity is trapped? And it's not just people looking to retire. It's a lot of people's wealth is in real estate. It's in the equity in their homes. And so what I'm going to speak about today with this retirement crisis is for people that own their homes outright and what they can do to secure monthly income in uncertain times. And what we don't often talk about, especially as real estate agents, because most real estate agents have no idea about how to do this or anything about it, is that when you own your home outright, like many people do, especially people getting ready to retire, they might have lived there for quite a long time, have tons of equity, and are looking to downsize or looking to fund their retirement lifestyle in some ways. And so what they typically do and what real estate agents tell them to do is to put their home on the market and sell it and cash out and collect their equity and go about their business. And that's sort of their retirement income. But here's where it gets a little more complicated because there's other ways to access that equity that can be more beneficial, potentially more beneficial to a seller and provide them with more specific, consistent income. And I'm talking about seller financing. So I'm talking about you being the bank, you selling your home, but instead of just selling it back to the bank, who's going to sell it to someone else, you are going to hold the note. You are going to collect payments with interest. You are going to be able to work out the terms you want. And then you are going to be able to collect a consistent monthly income from that. And no, you're not renting the place. You are collecting a mortgage payment. Now, for any realtor out there, when somebody comes to you, if you're a good realtor, my first question is going to be like, why are you selling? I don't think you should ever sell if you don't have to, because what happens is, people typically they play that sort of middle class trap where they build equity and then they pour all that equity back into a place where they got to spend a monthly, they upgrade their home and then they've lost all that equity and now they are, doing the same rat race again. They have the same giant payment and then they're just stuck. So all their equity is trapped again. But for people that own their own home, they have a lot of options because once you own your own home, you can kind of do what you want with it. You can sell it for magic beans. You can trade it for a Ferrari. You can do whatever you want with it once you own it. It's yours. And your average typical real estate agent buying and selling, and people too, owners of homes, buyers of homes, they only know one way to buy or sell a home, and that's to get a buyer with an approval, pre-approval letter from a mortgage company, the bank does everything. And I think it's going to be a lot more empowering for some people in certain circumstances, especially if they own their home. I'm not talking about if you still have a mortgage and wraparounds and lease options and other ways to do owner financing. I'm just talking about straight seller financing where you own your home and then you're going to sell it to somebody directly and collect those payments with interest. You are going to be the bank. That's what I'm talking about. Because let's say I'm looking to retire, and of course, to access that equity, I believe I need to just sell it back to the bank who's going to sell it to somebody else. I get a big old payment. I get a big old equity payment. It's large and in charge. Well, for a lot of people, that might work out for them. That might be the choice they want to do. They might want to put it towards other things. They might have plans for that money. But what happens is, let's say all your equity, all your retirement is in your home, which, without being too judgmental here, like if all your retirement income is trapped in the equity of your home, you haven't done a great job saving. You have not been good with money. You have not managed your money well. That's why it's all in your home. You don't have anything else. So now what are you going to do with this windfall of equity that you get? I can tell you what you're going to do. Most likely, you're going to piss it away somehow. One of your Uncle Johnny's going to have a great idea of investing and you're going to give it to him, or your kids are going to ask you for a loan. You're going to give it to them. You're not going to see it again. And so having a big equity windfall in retirement for a lot of people, I don't see working out very well because you don't know what to do with it. You don't have the history of demonstrating that you know what to do with a windfall. It's like a lottery winner. Like most people that win the lottery go broke. They don't know because they don't know what to do with a windfall. They have no idea what to do with this large amount of money. So if you are going to do seller financing, this provides you with a number of advantages. Is it simple? No, not necessarily. Is it as complicated as people may make it out to be? I also think no. So it involves a little more research. It involves a little more due diligence. It involves hiring a real estate attorney who specializes in these things. Disclaimer, I am not an attorney. I am a guy on the internet. My name is Doug Varenas, licensed real estate agent in Washington and Oregon. If we haven't met before, I am not an attorney. I'm a guy on YouTube. But if I'm looking to retire or I own my home in any way, even if I'm an investor, I think this is a really good exit strategy if you're looking for more consistent income every month instead of getting that windfall or 1031ing into another property. I think if you're an investor, you may have more practice with dealing with these large payments, large amounts of money, and you know how to allocate capital. But if you are Joe Schmo retiree who's trapped in their home equity, that's your big nest egg, you're going to blow that. So I'm offering you a potential alternative. Again, consult with your people about this. But basically what seller financing is you own your home outright and you can do what you want with it. So you can put it on the market and you can use a real estate agent, or you can not use a real estate agent. You can kind of give them a finder's fee because or you can pay them a straight commission. There's a lot of ways to work that out. But ultimately it would involve you selling your home to somebody at a certain price, at a certain interest rate, and for a certain amount of time. Now, because you are in control of your home, there are a million ways to structure this sort of deal. So if you did need a certain amount of windfall, like if you're looking to downsize and you needed a down payment, well, part of the seller financing could be requiring a 10, 20, 30% down payment from the person who's going to purchase it from you. That could be certainly a portion of or a part of the deal that you could structure in to make it worth your while to get some money up front to get you going in your next stage of life. And then you're collecting the monthly payments plus interest. So it works similar to a mortgage. You have a purchase price. A lot of people are looking for seller financing for whatever reason. They don't qualify for a traditional mortgage. Maybe they're contract workers. There could be any number of reasons. Or they're like me where they don't want to pay a bank to purchase a home. Like as an investor, I like to get seller financing or some kind of alternate creative financing, they call it, so I can put less money into a deal, or I can structure it the way I want it. Especially in a higher interest rate environment like today, you can potentially get a higher purchase price for your home overall if you're willing to accept a lower down payment or lower interest rate, because those are really the three factors in this transaction. You have a purchase price, you have an agreed upon interest rate, and then you have the terms, like how long are you going to do it? How is it structured? And so a couple of options are the straight 30-year amortization schedule where you have an agreed upon price. And a lot of times you can command a premium for your home because you're offering the seller financing and because you're offering a lower interest rate as an incentive to that buyer. You can ask for a higher purchase price. That's great. You don't have to go through this whole price reduction, paying all these fees. You can get that higher price point. And so that's going to be really advantageous for a seller. And again, you can capture the interest. So right now, interest rates are like 7% or something. If you charge 5.5%, 5%, you can hold on to that note and you collect that 5% for 30 years or whatever. And you can will that to your descendants if you pass away, and you're getting that consistent monthly. And so you are getting that consistent income and you're capturing that percentage. And if you know anything about an amortization schedule on a 30-year mortgage, like the first 10, even 15 years, the majority of the payment is interest. So in the event that your seller defaults, it returns back to you. You still own the property. And so this is going to be, so you're going to be collecting that consistent monthly income for the entire 30 years. Now you can structure it different ways where you can capture those terms in the first year, 2 years, 3 years, 5 years. And then at the end of that, you can request that there be a balloon payment written into the agreement where you get the entirety of your equity paid out at the end of that period. So it basically would work the same way as a 30-year mortgage. They would pay you a down payment. You would collect the principal and interest. And then at the end of that defined period, they would have to basically refinance or sell or something to get you your money. So you could structure it to where you're holding that note for a couple of years. And then after that, you're having a balloon payment to get all your money back. So in short, it's an option for people who want consistent income and to capture that monthly interest. Because when you just sell, you're giving that all back to the bank. You're losing it, especially when you own your home. You're giving it all right back to the bank. And unless you really need that windfall and you have a plan for it, a lot of times it might be more advantageous to, in fact, have a deal structured like this to where it guarantees you income. People are constantly talking about Social Security, and Social Security is not going to be there. And people talk about consistency of payment and retirement from pensions or annuities or some kind of retirement advice that gives them consistent income that has a high value. But they don't think about their home that way. It doesn't occur to anybody and nobody is talking about it. Investors are talking about it, but real estate agents aren't talking about it. And I don't hear a lot of talk about that in the retirement community. Tell me if I'm wrong. If you have done seller financing on your home or you know someone who has, I would love to hear about it in the comments. If you want to do this or you have a desire to do this with your home, you're in the Vancouver area or not, I'd love to talk to you about doing that too. I would love to work on selling your home via this structure. I think it's really interesting because the world is moving towards decentralization and direct to consumer and getting rid of middlemen who don't provide value. And for us to keep our assets over the long term and not to just give them back to an institution like a bank, again, might work for somebody, works for a lot of people, but it might not work for everybody. And so again, my name's Doug Varenas. I'm a real estate agent here in Vancouver, Washington, and licensed in Oregon. If you're thinking of buying, selling, or investing, I'd love to hear from you and just have a conversation. 100% no pressure. We can talk about real estate. That's what I love to do. And at the end, if you want to work with me, great. If you don't, that's great too. No worries. I hope this has been helpful. If it has, please do a like, a subscribe, and a share because that helps me out. Please post any questions in the comments. But I think this is really interesting. Again, you're going to need a real estate attorney to help you draw up this paperwork and to go over it. So that's going to be a fee for you. But a lot of times you can sell these directly to people and, you might have to pay a real estate agent sort of a finder's fee or like a transaction fee for that to help you. You definitely have to pay for the attorney, but it's not as complicated as it seems because like a mortgage, it's pretty basic in the underlying structure of it. You just have to basically wrap your mind around like you are the bank. But once you do, I think you might start seeing how you can structure these deals very creatively to get everything you want. And it really makes it a win-win situation because recently I've been in a situation where I wanted to buy a house and I wasn't happy with the terms I got from the bank. I just didn't want to pay that. And it was a decent rate, actually. I can't complain. But then there was also all the other paperwork I had to go through. And I had recently done some financial stuff that they were like, whoa, what's that? Even though it wasn't really that big of a deal. And so the underwriting for these deals, you still want to make sure people are going to pay you back. But the worst case scenario is like you have to foreclose on them and maybe they damage your home. It's not without risk. But at the end of the day, you still own your home if they default, and you just get it back, and you have collected their down payment and all the payments up until that point that they default. So that's a powerful thing too. And yes, it's an inconvenience, and yes, it wouldn't be fun to have to deal with that and pay the extra legal fees and stuff. But at the end of the day, you would be able to regain possession of your property and then sell it again. So I see this being incredibly advantageous for people who are looking to retire and don't necessarily need that windfall all at once. They might need a down payment's worth of windfall to get them going to the next stage, but then after that, they're going to get that consistent income. Again, hope you enjoyed this. I'll see you in the next episode.